Welcome to Next Round with the Pacific Research Institute. I'm your host, Rowena Itchon. In this podcast, Tim and I, PRI's Director of Communications, and I chat with Jared Walczak, a Senior Policy Analyst at the Tax Foundation. We discuss with Jared all matters of tax policy in California, and as you know, in the Golden State, that could take hours. But Tim, Jared, and I managed to hit the high points. Prop 13 and the split roll, California's tax structure, and the booms and busts it generates, the state and local tax deduction enacted by the Trump tax cuts, and rising local taxes. Thanks for joining us. Welcome to PRI's Next Round podcast, Jared.
Well, thank you for having me.
You're the Director of State Tax Policy at the Tax Foundation. For the benefit of our listeners who might not be familiar with the Tax Foundation, tell us about your organization and some of your projects.
Sure. We're a tax policy research nonprofit organization. We work at the federal, state, and increasingly also the global level, helping policymakers and the general public understand tax policy, understanding the trade-offs that come with it, looking for economically efficient and neutral ways to raise the revenue that governments need.
So the Tax Foundation is known for its various state rankings, and as sadly we know all too well in California, the Golden State is usually among the worst of your rankings. We know that California has the highest individual income tax rate in the country, the fifth highest in the amount of state and local income taxes it collects per capita. We're 49th in the state small business tax climate index, the 9th highest in the state sales tax, number 1 in the highest gas tax. The list goes on and on. So given that the tax burden is so high in our state, what are the long-term consequences of that?
Unfortunately, California's tax code is, as you say, uncompetitive. There are high rates, but more than that, there are also particularly high burdens on investment and certain economic opportunities that you want to be promoting. Now, California is still doing pretty well and will likely continue to do so for some time. There's a hub of innovation in California. There are a lot of great reasons why someone would want to be in the state. If you took California's tax code and you put it in Missouri, the state would probably empty out. But California can afford this. I mean, there's a higher cost of living already. People are willing to pay more to live in California, and that is also true of the tax code. But on the margin, you're driving people out. You see this slow trickle out of the state, high-income individuals, small business owners, entrepreneurs looking for other places. And one of the problems that California is going to face in the coming years is we've changed what tech agglomeration looks like. There was a time where if you wanted to have a tech startup, it basically had to be in the Silicon Valley. That's no longer true. Now, tech companies still like to operate near each other, but you have so many other choices now. You can go to the Seattle area, you can go to Pittsburgh or to Boston or to many other places. If California loses some of that edge, it's going to be much tougher given the high tax burdens that make it a little less attractive to work in the state.
Speaking of tax burden, Prop 13. So that's a law enacted by referendum back in 1978 that limits property tax hikes to an annual 1% to 2% of the property's value. And lately, it's been under fire as lawmakers attempt to chip away at the law. Most recently, it's taken in the form of a split roll tax, where commercial property would be taxed at higher rates. So the initiative was recently pulled from the ballot, and the organizers are offering a new version. What's your take? Do you think that California voters will ever go for an attack on Proposition 13?
I think that's a very tough thing in California, and probably for good reason. Prop 13 is the first movement in the tax revolt that begins in the 1970s and really sweeps across the country, where property taxes, which have been rising in a lot of states, suddenly got some serious pushback from property owners. And it makes sense. If you look at how fast property taxes were rising in California and elsewhere, it's out of control. It's way in advance of the cost of the government services being provided. So you get this pushback. Unfortunately, the pushback you get is not terribly well structured. By capping the growth of assessment value and by really only having that come back to anything approaching market rate when the property is sold, you have a lock-in effect, and you have this disproportionate impact of property taxes on newer properties and often on younger individuals. You create a situation where older, maybe retirees, have no incentive to downsize. It creates all of these perverse incentives in the code, and this isn't a good thing. Lots of states struggle with this. California is among the worst. But unraveling this is incredibly difficult because there is such a huge gap between between the current assessed value and what that value would be if you were to eliminate or phase out Prop 13. And of course, because the rates have been adjusted in some ways to reflect Prop 13, you just have this radical spike in taxes. I don't think property owners are going to go for that anytime soon. So what you've instead seen is this idea, well, what if we do split roll? What if we tax some properties at a higher assessment ratio? And of course, the target is commercial properties, to say they are going to be taxed functionally at a higher rate than other properties, regardless of their value. They can be valued the same amount, but we're going to tax them twice as much or some significant percentage more. This isn't good because, well, for a number of things, it discourages the best and highest use of the property. A property that might need to be converted into a commercial property, it's now more expensive to do so. It makes it just tougher to do business in the state, and it makes it really easy for local governments to continue ratcheting up the property taxes on businesses, which are much less sympathetic, while trying to maintain artificial rates for individuals. It just exacerbates the problem that was already created with Prop 13. The solution isn't to chip away. It's not to form a split roll tax. There aren't easy answers here. California does have a problem with property tax assessments, but it would just be making the system worse to have a split roll for businesses.
PRI's economist Wayne Weingarten recently published a study on the impact of the state and local tax deduction, which was passed as part of the 2017 federal tax reform legislation. High-tax states like California, New York, and New Jersey have toyed with various ideas to work around this cap, including complicated charitable deduction schemes. So what are some of these various proposals by these high-tax states, and do you think any of these are viable or even have a chance of passing?
Well, the state and local tax deduction cap has certainly been one of the more intensely discussed provisions of the Tax Cuts and Jobs Act. What's interesting is it's one of the most progressive elements of that change. You look at the cap and you look at what unrolling it would involve. The benefit of repealing or working around the $10,000 cap, 56% of that would go to the top 1%. 96% of it would go to the top quintile. This is very much a provision that is benefiting the highest income individuals. And of course, a state like California has some really high earners who took advantage of this. It's not good policy to have this deduction because what you're effectively doing is you're subsidizing high income individuals who live in high tax states and particularly high tax local communities. So all of the amenities of your bedroom estate, location are being, subsidized by the taxpayers in the rest of the country who are much lower income. It doesn't make a lot of sense. It reduces the cost of that high service provision that's only enjoyed by a small number of people. Bad tax policy. This was a good provision of federal law. But of course, you can see why states like California and also New York and a few others would want to work around this because it's made it less competitive to live in a state like California. We always talk about the question, do high-income individuals leave states because of high tax burden? And the tax wedge just got larger for them, mainly because it was subsidized earlier. The highest income individuals in this country got to have a significant portion of their state and local taxes sort of pushed off on the rest of us, which isn't a really good way to do tax policy. They can't get that anymore, so they're bearing most of the brunt of the taxes that a state like California puts on them. So California and other states have looked at these alternatives. They're gimmicks, and they're obviously gimmicks. The one you referenced, the charitable workaround, for those who may not be familiar with it, here's the basic gist of it. What if we created a fund, some sort of, we'll call it a charity, that is just an alternative way of funding state government, or maybe some element of state government like education, public education. And what if you could write a big check to that government fund, call it a charitable contribution, and then get a credit against it, reducing your tax liability? Now, we can all see this as a shell game. You haven't actually changed the fact you are writing a check to the government, and it's in satisfaction of liability in taxes. But you've called it charity rather than taxes. And the idea is, now you can take the federal charitable deduction, which is basically uncapped, instead of the deduction for state and local taxes paid, which is capped at $10,000. The IRS saw right through this shell game. It's kind of obvious. They said, no, that's actually a satisfaction of tax liability. It's still taxes paid. And there are lots of existing rules. They've been longstanding case law and regulatory guidance on this that says a couple of things. One, true charity for purposes of the charitable deduction has to primarily benefit the recipient. It cannot primarily benefit the donor. And in this case, that's really what it's doing. It's for you, not for a charity. There are some other arm's length type rules. The quid pro quo quo piece that I mentioned. There's lots of reasons why the IRS pretty quickly came and said, nope, sorry, this doesn't work. And they've have some rulemaking that helps clarify the details, but that one is basically out. States tried it. They were slapped down. There is some litigation pending. New Jersey, New York, and Connecticut are trying to address it. That seems unlikely to go anywhere. There are other approaches that have been tried. There is the idea of creating a payroll tax as an alternative to an income tax. That gets extremely convoluted. It's hard to have a progressive graduated rate payroll tax. It's really difficult to work in all of the different provisions you normally have in an income tax into this payroll tax. Plus, it misses things that are payroll. So, all of your investment income, everything else isn't part of that. But that was one supposed solution, because if a business is paying it, then there's no cap because it's a business expense. Again, bad solution, bad tax policy, makes a hash of the entire tax code just to try to get this benefit that mainly flows to the top 1%. And there have been other proposals just for small businesses or others. Most states are abandoning these efforts because they realize they're convoluted, legally suspect. The IRS is going to slap most, if not all of them down, and they're benefiting a very small number of taxpayers at the expense of basically breaking your tax code.
So thanks to a booming economy, California has enjoyed big budget surpluses in recent years. And because of the state's tax structure, as you alluded to earlier, a lot of that surplus comes from cap gains taxes held by employees and stockholders of firms that IPOs, such as Uber and Lyft. Now, many economists believe that there's a heightened risk of recession. And of course, that could spell big trouble for the state's coffers. What's your solution for what we here at PRI call California's revenue roller coaster?
California and other similarly situated states have a problem that is really difficult to resolve. And it's a good problem to have in some respects. You have a lot of high income, high net worth individuals who are substantially investing. And in good years, that is great. You have capital gains realizations, and those realization events yield incredibly high income tax revenue. That's especially true with a graduated rate of very progressive income tax, as you have in California with that top rate of 13.3%. The flip side of that, of course, is that in a bad year, that money basically just disappears. The vast majority of people, even in a recession, will have a salary. They'll have a job. But on the other hand, people probably aren't earning returns in the market. They're losing. In fact, they have capital losses that they're claiming against their taxes. So you have extreme volatility when you have the combination of a really high income state with a highly progressive tax. One solution to that is to have a less progressive tax code that does have a smoothing effect. Another thing that states do, and California has done some of this, some states have gone far further in this, is setting aside a lot of the revenue that's associated with capital gains and investment income and keeping that out of the recurring revenues budget, treating it as one-time expenditure money or paying down pension debt or making other sort of investments that don't require a recurring appropriation, recognizing this is super normal. This isn't what we can always expect. California has done better than some in recognizing that and trying to keep that out. And I think former Governor Brown deserves some credit for his approach to that. There's a lot of money in surpluses and in rainy day funds in part because he recognized that volatility. But that's an important thing to maintain. You can't spend all that money in the good years because California will take a bigger hit than most other states will. The second element of this is that you look for more stable taxes to lean on more. Frankly, California leans too much on its income tax, which is going to be highly volatile. It's challenging because you also have high taxes elsewhere. It's not like you can shift into the low rate sales tax. You have a high rate sales tax too in almost all jurisdictions, but the balance is probably too much towards these more volatile forms of revenue. So, doubling down on the rainy day funds, not overspending is really important. And then, of course, you really don't want to impose business taxes that would drive companies out of state. So whether it's the so-called IPO tax, which really is a stock options tax, it's not an IPO tax, but whether it's that or a CEO tax or anything else that's going to make the state less attractive at the same time that you're potentially going to have reduced earnings and returns for a lot of these startups and a lot of these corporations, that's probably not the right way to go.
California, as we mentioned earlier, has the highest individual tax rates, so it goes without saying that the consequence has been that some of our most productive residents, think successful business people and pro athletes and tech entrepreneurs, have been hightailing out of the state. Now, surveys and data show that the middle class is on their heels. So while the state is currently prospering, what's the long-term prognosis?
Well, you're certainly right that some successful business people and athletes have left, although I don't think that's quite why the Raiders left. But we do have this issue in California and other states. At some point, you price people out. And in a state like California, part of the problem is the tax cost that can potentially work for San Francisco or Los Angeles, for tech entrepreneurs or for higher income people, doesn't work nearly as well in the rural parts of the state. You have plenty of California that isn't the rest of the country image of California. And yet you have a tax code that's relatively inflexible towards them that still has those high rates. And that becomes a significant problem. It makes it hard to be competitive in those areas. I do think that there's a concern that you're going to see continued outmigration, a lot of it regional. You're going to see more people going to Arizona, maybe to Nevada. I think Utah's seeing a big uptick in this outmigration from California. You're going to keep seeing that. Again, California is not on some precipice. The state is doing very well. A lot of states would like to be where California is. You have the climate, you have the tech community, you have just there's a lot going for California. But you should always be watching these trends. I think that the tax saturation is about as high as it can get. And it's concerning when you see policymakers at the state and local level talking about ways to wring more revenue out of businesses and out of individuals in the state, because you do reach a tipping point. There is competition among the states and across the world. This is a very global economy, and California is extremely integrated into that global economy. People can leave, and as we see, they do leave. And as you say, it's gone from maybe a few high net worth individuals doing tax planning to members of the middle class looking for a better opportunity. And that's driven both directly, people trying to reduce their tax liability, but also indirectly when businesses decide it's better to open up shop in another state and the jobs follow them.
Recently, you were on CNBC to discuss the San Francisco proposal to tax companies whose CEOs earn more than 100 times the median income of the employees. What are the consequences of such a tax? Ultimately, wouldn't it just scare a lot more firms out of the city?
I think there's absolutely that potential. It sort of seems that San Francisco is on a mission to make it more expensive for large businesses to locate in the city. And that's a concern. Now, I know well-compensated CEOs are not a terribly sympathetic population, but there's good reasons not to penalize companies for paying their executives well. Firstly, we should generally assume that businesses are doing this because they think they're getting a return. Now, some of them are wrong. Some businesses pay a lot for a CEO and they're not good at their job. But businesses, they're responsive to their shareholders. They're doing this because they think they are going to be more profitable. They're going to be more successful. If they're right and we penalize them for that, that's worse for their employees, because a company that's not succeeding is not hiring more and it's not paying its employees as well. Beyond that, it's just part of this continued tax on businesses in the city, a tax that we don't have a lot of background for. Only Portland has tried this, and it's pretty small. But in San Francisco's case, it is ratcheting up the rates on a really uncompetitive tax. It's on a gross receipts tax. It's a tax that falls on your gross revenue, regardless of your profitability. Basically, it can pyramid across the production process. You can pay it on multiples of your actual profits. It's the sort of tax you really don't want to double down on, and San Francisco is unfortunately eyeing that possibility. It's a tax that ostensibly targets a particular business decision, but the effect's just to increase burdens on some of the city's largest businesses. Many of them clearly want to be in San Francisco and the surrounding areas, but I think as the diffusion of the tech clusters demonstrate, there's limits, and there's other places to go if the burdens get too high.
One of the tax issues that doesn't always receive attention are local sales taxes. And you recently did a study on state and local sales taxes, and you found that 2 California cities made it to the top of your list, Long Beach and Glendale. Both of these cities charge a combined state and local sales tax rate of 10.25%. Now, I, for one, know that when I'm in a lower tax city or state, I actually might do a little more shopping. Do you find that this kind of sales tax tourism really exists?
Yes, there are studies that look at cross-border activity with taxes. Sometimes it can be extreme. We see this with, say, cigarette taxes, where there is organized cigarette smuggling. With sales tax differentials, we don't see that. We definitely see the illegal version of this arbitrage, where individuals will shop across a border, or where, in fact, the businesses will make this decision for them by locating along the lower tax side of one of those borders. You can see this in a lot of states. You drive down an interstate and suddenly you see this big cluster of businesses. And if you pulled out a map, you'd see you just entered into a lower sales tax jurisdiction, or maybe a lower other tax jurisdiction. So there are limits on how far someone's willing to drive to buy groceries. You're not going to necessarily drive 30 miles. There's a value of your time. There's a value of gasoline, which you have high gas tax rates too. But yeah, you'll make this decision. And of course, sometimes it's just convenient. Someone who's already in another city with a much lower tax rate might buy there. People making larger retail purchases might go to the stores where they locate in those jurisdictions. There's definitely tax competition that takes place, especially when the sales tax rates get that high. We're not talking about the difference between 5 and 6%, as you might see in a lot of jurisdictions. 10.25% in Long Beach and Glendale. That's about as high as it gets.
Finally, for our last question, Jared, we call our podcast Next Round because PRI San Francisco headquarters is near wine country, and we all like to drink an alcoholic beverage now and then while talking about policy. After your tax policy research, especially here in California, you might need a little cheering. So what's a favorite wine, beer, or cocktail recommendation for our listeners?
You might have brought the wrong person onto your show. I'm not quite a teetotaler, but I think the last time I had an alcoholic beverage was on New Year's Day. I just don't really care for it much. Sorry to all of those in California wine country. I know it's great stuff, but for me, I'll just raise a glass of Mountain Dew and recognize how sad that sounds.
Thanks so much, Jared.
Well, thank you for having me.
Special thanks to our guest Jared Walczak and to Tim Anaya. To read more of Jared's work, go to taxfoundation.org. If you're in the Southern California area, join us on November 9th for our Baroness Margaret Thatcher dinner in Newport Beach. Our keynote speaker is entrepreneur and philanthropist Peter Thiel. For more information, go to our website at pacificresearch.org. If you like this episode, please tell your friends and subscribe to PRI's podcast at iTunes, Google Play, Stitcher, or TuneIn. And please do us a favor and give us 5 stars. You can also listen to our podcast on PRI's YouTube page, youtube.com/Pacific Research 1. That's the number 1. Thanks for listening. I'm Rowena Ichon. We hope you'll come back again for Next Round with PRI.